Good evening, everybody. It's Juli Pitra, and tonight we'll have Pitranomics Thursday Talks, where we talk about the 10-part strategy to grow, protect, and transfer wealth called Pitranomics. And tonight I'm really excited because for those of you that file taxes late, just at the extension, kind of like me, tax season is over. Hopefully you have all filed and you're compliant. And tonight we have one of my awesome partners. His name is Michael Ross. His company is called Michael A. Ross CPA PC. He is, and I don't want to miss any credentials, he is a certified public accountant, but he is also a certified valuation analyst, a certified fraud examiner, and he has certification in financial forensics. So that's a lot. Thank you very much for taking the time to come after such a busy tax season. Michael Ross, come on down.
I'm still recovering, by the way, from tax season. So
yeah, so are we.
It was a rough one.
So can we spotlight Michael as well, please? So he's got both of us up here. And Michael, just feel free to tell us a little bit about your business, and then I'll bring up the presentation.
About my business?
Mm-hmm. About your business and what you do and how you help people.
Sure. So I got interested in the fraud and forensics area back in 2013. And basically, however, before that time, I really focused my business on what's called management advisory services. And basically what that means is, other than accounting and tax, one of the things that I really enjoyed doing was putting together business plan documents for companies that were trying to raise capital. And what happened was, I was the CFO of a medium-sized company in the late 80s. And I had a consultant come in that was a professor at SMU. He also headed up the entrepreneurial section of the school. And so I called him in to have him help me and my employer put together a business plan. And we did that successfully. I actually learned how to do business plans. And then I decided a couple of years later, when I went out on my own, to sort of do that. And I've been doing that since 1989. I put together business plans, private placement memorandums, things of that nature for companies that are trying to raise capital. And I still do a lot of that. But then I wanted to branch into the forensics area, the fraud and forensics area. And so I started to get into that in 2013. And it's been a very good choice. I love the work. Basically, it has to do with litigation support in many cases, but there's other aspects to fraud and forensics, like business valuations and things of that nature. I do a lot of matrimonial and family type stuff where people are going through a divorce and they need to bring in a forensic accountant to help with the property settlement. So I do an awful lot of that. I do commercial litigation support where obviously there's civil litigation, people are suing each other, there's damages, and I get involved in basically I put together the damages for the client. I do that in a letter report, and then I testify as an expert witness in trial. I also do consulting. I'm also a consulting expert in that sometimes I don't need to testify, and a consulting expert does not have to produce documents for the opposing counsel. It's the consultant expert's work is not discoverable. An expert's work is. So basically, there's kind of two ways to work in that regard. I work very closely with attorneys, and so that's kind of the nature and overview of my practice. I do tax returns. I do a lot of tax work. I do accounting work, and so I have a pretty good service offering in terms of clients and solutions I can bring to clients. And so I've been now in my 41st or 42nd year of doing it. I love doing it. I wanted to become an accountant when I was, back when I was 17 years old. I'm still doing it. I still love it, still learning, and it's my passion. So anyway, that's all. That's about it.
No, I appreciate that description. And what I want to bring attention to is all of the many things that you did, which are interesting and fascinating. Last was tax and accounting, we're going to talk about taxes today. In particular, we're going to get into the 1040 and how it is a tool to help you understand ways to minimize your taxes. And Michael's going to talk specifically to that. But just to understand all that he does, he is not just a CPA. He doesn't just do tax returns. He's a really good partner for strategizing how you're going to minimize your tax burden going forward. So here it is, October of 2023. It is time to start planning for minimizing taxes in 2024. Don't wait until next year. Get started now. Get yourself a good partner. Michael, I've taken the liberty of asking Shamir and Hannah to put together a presentation that will kind of guide us. If you need to go off tangent from this, it's just helping us have a visual. And I'm really excited to share this information. So a quick overview of what it is I like to teach. It's Pitranomics, a 10-part strategy to grow, protect, and transfer wealth. And the strategies tonight we're going to hit on is pay Uncle Sam what he's due. One of our biggest expenses in our budgets are the taxes that we have to pay. And the other strategy we'll hit on is get professional help. So when you do have someone help you, someone like Mr. Michael Ross here is just an unimaginably great partner. His information will be provided later so we can all share it. So pay Uncle Sam what he's due, the 1040 deconstruction. Oops, I went the wrong way, sorry. And we got a little bit of information. We'll come back to that. I cannot seem to go through this. Sorry for the, so what Michael told me is two ways, or the best ways to minimize taxes, is deferral of income. And let's see, we're going to just go back and let Michael talk to that a little bit. So deferral of income.
Can I just say, before we get into the presentation, so, the idea here is we want to save taxes. That's all. Everybody wants to do that. But before we talk about the ways that can be done, we need to talk about tax avoidance and tax evasion. Okay.
Yes.
I'm sure many of you have heard this, but tax avoidance is completely legal. Tax evasion, however, is illegal. And you need to be aware of that because there are many folks that absolutely will take a position that is, what they believe may be the latest and greatest way to, to shelter income. And over the years, I come across cases of people that bought into that ended up committing tax evasion. And the penalties are very severe on that, and you will need a criminal tax attorney. Tax avoidance, however, is perfectly legal, and it's something that we strive for. We try to look at your situation and we try to figure out a way, how can you avoid taxes? So everything that follows from a tactical perspective is in Julie's presentation. And strategically, though, I wanted everybody to kind of get a sense of, the big picture. Tax avoidance is what we're trying to do. Tax avoidance is also known as tax planning. So with that, I'm going to let Julie go back to Julie.
Well, thank you. And, one of the things that having sound professional help helps you avoid are those people that will sell you, how did you call it? Those schemes that shelter income, but basically you're engaging in tax evasion. And I'm not looking to be in jail when I'm 70 because I've spent too many years not following sound practices for tax avoidance. And as I asked Michael earlier, what are the best ways to minimize taxes? And he said deferral of income and acceleration of expenses. And so can you speak to that a little bit? And my plan was to write some notes on this presentation as you spoke, but I have no idea where my pencil is and couldn't find it. So I'll just take notes.
Okay, Julie. So before we get into that, I want to mention to you that if your books are not up to date, no one can do a good job tax planning for you. And I cannot stress how important it is to stay up with your books. Now, many of you have your books in your head, and a lot of people operate that way. But when you grow and you get complicated, sometimes what happens is the books become sort of a second or third tier priority. And the problem is when that happens and you're that complicated, if your books aren't ready, you just, no one can help you with tax planning. So I just have to stress the importance of keeping up with your books. The larger you are, the more frequent you have to do it. If you're a small business, every quarter is probably okay. If you're a medium-sized business, you got to do it every month. And you got to make sure you're generating financials that are accurate every single month. And the reason why that's important is because some of you are going to have to pay quarterly income taxes, and we need to know, the accountant needs to know how much money you've made. Some of you could say, well, I took in this much revenue, my profit margin is this much, this is how much I probably made, and that's okay when you're small to do that. When you get complicated, the number of transactions exponentially grow an order of magnitude. So it's important that you stay up with your books. I can't stress that enough.
What I'd like to add is oftentimes I get the question, what do we need? What do people need to keep up their books? And the simplest answer is what you'll use. But as your business becomes more complicated and larger, it does behoove one to have a system robust enough to handle it. Now, 5 years ago, I guess, Michael, when did you and I cross paths? I think 2019.
Yeah, we started working together in 2019.
Yep. My books were not okay. My books were horrible. And I was under pressure to get them up to speed fairly quickly. And so with the work of a really talented bookkeeper and, of course, Michael Ross, I was able to get my books in order. Now, as of right now, I'm lagging. I'm not saying, hey, I'm the perfect example of how it should be. But the first step is to understand how important keeping your books, or at least getting them up to date. So, that's something I'd like to touch on again later. But no one as wonderful as Michael Ross can help you if you don't have any books to speak of. So first step, get your proverbial house in order.
Well said, Juli, well said, well spoken.
Thank you. So once you have your books in order and we come to see you and we're like, Michael, how can we minimize our taxes? And you tell us.
Well, I tell you basically around the third quarter of every year, which is I would say the July through September timeframe is, let's see where we're at and let's decide what can we do. Deferral of income is basically moving income from one tax year to another tax year, to a subsequent tax year. And there's several ways that you can accomplish that. One way you can do that is you can tell your customers to pay you after December 31st of the tax year. So that's one way. It's a real simple way. You just say, look, don't send me a check, post date the check, or not post date, postmark the check January 1, and send it to me January 1 of the subsequent year. And this way you basically can defer income and the related tax on that by a year and a half when you have to report or you have to prepare your tax return. There's other interesting ways to defer income. One way is to change your fiscal year, change from a calendar year to a fiscal year. In many cases, it can be done. And for example, clients, sometimes you'll set up a client with a January 31 fiscal year ending. This way, all that income from the prior year can get deferred to the next year. So that's one way of doing it. It used to be very easy to change your tax year. The IRS has made it much more difficult, especially with pass-through entities like S corporations or partnerships, and or LLCs, which can either be taxed as an S corp or a partnership. So, but that's not to say it cannot be done. I have one client that is a nonprofit, and they said, hey, we have to move our tax year. We moved them from a calendar year to a June 30th year end. We did that a few years ago, and now they're coming back and they're saying we need to move it back to a December. So I might have to do that for the client, and there's various reasons for that. The issue the client has is, well, where we operate, which is in Africa, we have to, it's a state in Africa or a country in Africa, nonprofits have to have a calendar year end. So that's what I'm being told. And so we may have to move it back, but I like if the opportunity exists to move a tax year, I would encourage that. The IRS has made it much more difficult, but it can be done in certain situations. You'll see a lot of C corporations, big companies, C corporations that have a fiscal year. And that's also a mechanism to defer income.
Okay, so I got that. I don't think I've ever asked you about that. So I'll put that in my notes for us to discuss later if there's a more optimal fiscal year for me in my business.
Okay.
So,
Okay.
and what are some other ways? So for people who are, for example, W-2 employees, they don't have the option of, I guess, of changing their fiscal year. What are some ways that W-2 income, so salaried people, can defer their income?
Sure. And let me just say this on deferral thing. It's great if you can call a customer up and say, hey, can you defer payment to me till next year? this is in the latter part of December. You want, but the problem is that customer might tell you, well, look, I'm looking for a tax benefit by paying you by year end. So you have to be aware of that, it may require not last minute planning, but more of a discussion about, look, I'm really trying to do this. I understand, your need to want to deduct it. You can't mail it on December 31 and it shows up at the bank account in January. That's called constructive receipt. In other words, if somebody pays you if it's put in the mail on December 31, it's constructively received in that tax year, as opposed, even though you don't get the check till the next tax year. So the notion of constructive receipt is important.
So does that also matter what date's on the check? Or that's what date you receive the check?
It's basically what the postmark looks like. If it's postmarked December 31, you're going to have to. Now, let me just say that people do this all the time. They don't report the income till the following year. Some of them are cash basis, but you have to be careful with constructive receipt or constructive disbursement. So, because the IRS can go back and say, look, you constructively received that money at the end of December, even though you reported it in January.
So does that mean, because this is new for me, do we need to keep the envelopes that we receive checks in?
No, I don't think, I don't want to create a situation where it's laborious. Okay. Most cash basis taxpayers will report that check in January. Okay. And, but if it's a large check and you get audited by the IRS, then, that may be problematic if the IRS should somehow ask you to prove that you didn't receive it in December 31. So
okay.
Just the idea is that if you're a big fish, it could be problematic. And it can be especially problematic, in a corporate environment where company A pays company B, and the constructive payment, constructive receipt is can be an issue.
Especially if it shows up on, say, current year on company A, who sends the check to company B, who shows it as received in the next year,
Yes,
right?
correct.
Okay.
Absolutely.
All right. So that's not, I don't think that's something that's really big for me, but that would definitely be something to consider. So let's get back to, I won't call them normal folk, but most people think, I earn a salary. What are some ways that I could take advantage of tax avoidance and not lean over into tax evasion? So what's good for the W-2?
If you're a W-2 employee, sometimes bonuses are paid in December, and the employer may want to deduct it. The employee may say, well, look, I'd really like to take that bonus into next year. Can you pay me on January 1? So that would be a way that I think, one way that an employee could defer income is by just waiting for the bonus to be in January. And it may not make a big deal to the employer. Employer may say, oh, I'm cool with it. That's good.
Okay. Doesn't hurt their balance sheet or income statement as much as it does the employee, right?
That's right.
Okay. What about what's your take on retirement accounts, IRAs, 401ks, things like that?
I think they're great. Especially, if you start when you're young and you do it every year. I gotta tell you, I see people with $1 million retirement accounts. Okay. They were very disciplined. They did it they started when they were very young. They did well, they had a good job, and now they've got a $2 or $3 million retirement kitty. So yes, I would encourage it. Most things in this area are IRAs, traditional IRAs. You can do a Roth IRA. The traditional IRA is deductible on your tax return. The Roth IRA isn't, but the income isn't taxable either when you take it a distribution down the road. So there's benefits to Roth and traditional IRAs. I like 401k plans are very good. Another way, although now you're starting to see more Roth 401ks, especially with high income taxpayers. There's what's called a SEP IRA, which is a simplified employee pension for self-employed people. That's a very nice vehicle. You can defer, you can take basically 25% of your income and defer it. And by putting it into a SEP IRA, simplified employee pension IRA, you can have a solo 401k.
Now, are the SEP and the solo available for the W-2 employee?
No.
Okay.
That's only self-employed folks that have Schedule C, that have S Corp income or Schedule C income.
Okay, so for W-2 employees, we need to think about, what did you say? Let's see, deferring your bonus.
Traditional IRA or a Roth IRA is the way to go.
Okay.
Absolutely.
Right.
And the thing about the traditional IRAs, you get a deduction on your tax return in the year that you actually you can do the IRA up to the due date of your return, including extensions, and you can do a SEP IRA up to the year that, or up to the due date of your return, including extensions. But if you get that, if you do a traditional IRA, you're going to be taxed on that income as it starts to become or as it starts to be distributed. For example, when you turn age 59 and a half. So the thing about the Roth IRA is it's not deductible against your tax return, but the earnings are not taxable to you. So you see a lot of people that end up having traditional IRAs, and they convert them over to Roth IRAs. At that point, you pay the tax, but as the Roth balance, as the income accumulates, after that point, it's not taxable. So
one of the things I've wondered, so if you have a Roth IRA, and it accumulates tax-free, are the distributions safe from taxes? Or
yes,
are they taxed?
Yes,
okay.
They are.
Okay.
Either
So
Roth IRA or Roth 401k. Distributions are not taxable.
All right. I took the presentation away because I wanted everybody to be able to see Michael a little bit better. But so for the self-employed person, the solo 401k and the SEP IRA, SEP 401k, whatever, solo
SEP IRA
SEP
and the
IRA.
solo 401k.
Okay.
And there are other types of plans that are out there, but the most popular are the SEP and the solo.
You know, when my husband was working, I think it was still for EDS or maybe it was Dell, they had a program where they would take part of your income and put it in this pension that you would then be distributed later.
Right.
So you didn't receive the income, it went into a pension. The really weird thing about it was they discontinued that pension and they distributed all the money in the current year. I was like, that's not helpful.
Well, let me say this, Julie, about pensions. Before the advent or popularity of 401ks, Okay.
Mhm.
401k was originally set up as a profit sharing situation.
Mhm.
In other words, the employer contribution is only out of profits. However, before the popularity of those, there were pensions that employers had to set up. And what happened was there's two types of pensions. There's a defined benefit and a defined contribution. But what happened is on these defined contribution, which means that the employer knows what that contribution is. Oftentimes what would happen is that employers wouldn't fund these pensions. And what happened was sometimes they would fail. Okay, the company would fail and the pension wouldn't get funded. So the pension benefit guarantee company would come in and have to basically guarantee that. That sort of went away. The popularity of pensions sort of just went away to these to these 401k plans, where only if the employer has a profit are they able to fund,
Right.
So it basically, and not only that, but it just seemed to work better. There was more clarity and things of that nature.
And those are for people. Now, when the employer had to participate in the pension, everybody had some contribution to their pension, but not everybody contributes to the 401k, do they?
Right. There are matching. There are ways that you can match. The employer will match an employee's contribution. So that's, another benefit there. But overall, it is an excellent vehicle to essentially be an employee and build up and defer income and taxes.
Okay. So those are some ways that I think all the W-2 and the self-employed and the I guess, what is it? Self-employed and 1099, right? Let's talk about the 1099 employee a little bit. What ways do they have to defer income? Same way?
SEP IRA.
SEP IRAs? Okay.
A regular IRA, a SEP IRA. The SEP IRA is nice because it's 25% of your income up to a certain amount. And I think that number's 310,000.
Okay. And the thing about being able to, I'm so sorry, but I was going to say the thing about being able to, go ahead, Mike.
SEP IRA is excellent. I mean, I have numerous clients that do that. And I do that myself for my business. And it's just a great way to defer taxes. And you can do a lot. You can, I think this last year, you can do up to 66,000, up to, including if you're over 50, you can do catch-up contributions. So very, very good way to defer income.
Okay. And then for people who are, have, say, self-employed businesses that don't actually show income on their books, they show maybe a loss, they can't contribute to these, right? You have to show income on your books, not just revenue.
Yeah.
Okay.
You can make a contribution to a regular IRA or either a traditional IRA or a Roth IRA, but you have to have profits to get a deductible or to get a deduction for that SEP IRA.
Okay.
That deduction is an adjustment to gross income. So it's gross income minus the SEP IRA deduction equals adjusted gross income less itemized or standard deduction equals taxable income. It's
And we're
actually
going to come back to that because I'm going to bring up the 1040 in a little bit. After we talk a little bit, please, Michael, what are some possible ways to accelerate expenses?
Right. Well, a self-employed person has the ability to negotiate with their customers. They can call them up and say, look, send me that check on January 1. That's one way. And there's that flexibility there. Another way of another way of minimizing self-employment income is to accelerate expenses, i.e., let's pay the expenses in the current year versus the next year. Pay them before they're due. So that's an excellent way to defer income, create lower net income, defer that income, defer the tax.
Okay. One of the things that I used to do, which I don't know, I guess I got out of it, is for my rental portfolio to pay property taxes in a year, try to figure out when to pay it when it was most advantageous. So looking at what, say it's 2023 now, I have to pay 2022 taxes have accrued throughout the year. I could pay them this year if it looks like my income is really high and accelerate those expenses into the current year, as long as I've planned carefully not to have even higher revenue in the following year, which is where someone like you comes into play because you're really helping people strategically make those kind of decisions. Is that correct?
Let's talk about the property taxes in particular, because that's a very important issue. So I used to tell people, pay your property taxes on December 31 as opposed to January 31 when they're due. Okay. And that was great because there was an unlimited sales tax deduction. I'm sorry, there was an unlimited property tax deduction on if you itemized. Okay. Well, as part of the tax TCJA back in 2017, you can now only deduct up to $10,000 of sales and property taxes, any type of tax really, only $10,000. So now, if a client pays $22,000, let's say, at the end of December, $12,000 of that is not going to be deductible. So what you want to tell that person, look, pay 10 now and pay 12 next year, okay? Even though you'll only get 10, as opposed to paying 22 now and only getting a deduction for 10.
Right. And what's great about my business when it comes to property taxes, not my personal property taxes on my home, but for the investment portfolio taxes, is that those taxes are expenses for doing business of having rental real estate.
Right.
And so the timing of when those are paid for someone like me or someone like in that business do become crucial and become a form of strategy. Is that correct?
Absolutely.
Okay.
Absolutely. So, in your situation, well, I don't really want to speak to your situation, it's confidential, but,
right.
we should have a discussion when you're getting ready to, around year end, we should have this discussion about when to pay your property taxes. Absolutely.
Right. What are other ways to accelerate expenses, particularly for the W-2 employee? What are some other ways?
Well, I think that's harder. It's harder for the W-2 employee to accelerate expenses. However, let me say this, the 2017 tax changes, they made it a lot more difficult for employees to deduct employee business expenses. It's almost impossible now to deduct employee business expenses. And the reason why is it was an area of tremendous abuse. And so now it's almost impossible to do that. There are some exceptions, but for the most part, it's very difficult, extremely difficult.
Extremely difficult. What about medical?
Medical? Yeah, I mean, any taxpayer, whether they're self-employed, whether they're W-2 or self-employed, if you've got, unreimbursed medical expenses, that can be deducted to the extent that they exceed 7.5% of your gross income. Now, let me just say, in relation to medical, let's talk about health savings accounts, because anybody can have a health savings account. Most employers offer their employees a health savings account, and most self-employed people can have a health savings account. That's $7,300 a year, and if you're over 50, it could be $8,300 a year, and you can get a deduction not only for that $8,300, but then you can use that $8,300 to pay self-employed health insurance premiums. So you almost get a double deduction by doing that. So that's an important. That's really a good situation for self-employed folks that they have to pay their own insurance, and so that's a way to get not only the health savings account deduction, but also the self-employed health insurance deduction.
Okay.
I know I'm going a little bit fast, so if anybody has any questions, please let me know on that.
No. I love that. And it's also, you can contribute to these HSAs and then use the funds later in life. Is that correct?
Correct. Yeah.
So perhaps when, right now my husband's working and has a really good plan, but let's say he retires and we have to pay for our own insurance premiums out of our pockets, then we can use those funds in order to do so. Is that correct?
Yes.
Okay. All right. So we've talked about ways to accelerate expenses and to defer income. Let's open it up to see if anybody has any questions about maybe in their particular case, what they'd like to know.
Well, we must be doing a great job, Julie.
No one has any questions?
I have something off topic that I want to talk about.
Okay. That's David.
CTA, Michael.
Hey, David, how you been?
Good. And yourself?
Good, thanks.
Good. The CTA, the
CTA?
Corporate Transparency Act.
Oh, yes. I did want to thank you. Okay.
What are your thoughts on that? I'm dying to hear this.
Well, Corporate Transparency Act. I haven't heard of it. I'm sorry. Maybe I've heard it under something else. Let me look at it real quickly.
Where you have to, we talked about it, Michael, where you have to identify the beneficial owner of corporations or entities starting, when is that, David?
January 1st.
January 1st, yeah. So we've actually discussed it a little.
Okay. Let me just say this. I'm looking it up. So in whatever we would have to do with corporations, we would always have to disclose people that own more than a certain percentage of the stock of a company. They have to be disclosed, okay, on the tax return. And it's not that hard to do on an S corporation, because the part of the S corporation has a K1 that lists who the owners are of the S corporation. Basically, what I'm reading here is it says the CTA largely applies to foreign-owned shell companies. However, all companies should review the definition of reporting company and all of its related exceptions. Now, there are what are called reportable transactions that have to be reported on an IRS form. It's actually a form called that is called reportable transactions. And I just looked at one the other day, believe it or not. I have a client who's going through a divorce, and the client is a very high net worth client. It's a doctor. I'm representing the wife in this divorce, and she had me look at some tax returns a few days ago. And I saw that there was a $700,000 charitable contribution deduction on the return.
Damn.
Right. And
Did
it was
catch your eye?
oh, absolutely caught my eye right away. And I started to look at it, and the client had invested in a solar project. And as part of it, they did a conservation easement on X number of acres, and they took a charitable contribution deduction on it. And where that falls is that it's called appreciation of it's charitable contribution. It's appreciation of donated property is what it is. Okay, so what happens is you buy a piece of property, 100,000, let's say. You do a conservation easement on 40% of it. That's 40,000. However, you do that easement 5 years later after you pay that 100. Let's say the property is now worth 500,000. Okay, well that appreciated property is now a $200,000 deduction. Okay, so I didn't prepare the tax return for the client. The client has their own accountant who did it, and that ended up being a reportable transaction. And a reportable transaction is important because what the IRS is trying to do is there have been so many abusive tax shelters throughout since the tax code was started in 1903. But the notion of abusive tax shelters, the IRS has cracked down on like 98% of them, but still there's some of them that get through. Some of them are fraudulent. You have to be very careful, but the IRS basically says, hey, this is a reportable transaction. You have to report it as such as part of your 1040. So,
Michael, just for clarification, on the doctor's tax return, they showed it as a deduction, so decreasing income.
Right.
But they needed to, what's the greater scrutiny that it gets? Because it is showing up on their 1040, one of their schedules. What sort of form is showing that?
Let me just say this, that it's pretty much you have a very good likelihood of getting audited with something like this. You just do. And the amount is problematic. I mean, it just sticks out like a sore thumb. But it's done by very wealthy people. They do it all the time. Some of them, the deduction ends up getting denied. Some of them get in trouble over it. I've seen accountants that advise their clients on something like this, and the accountant ended up getting in a lot of trouble because it was illegal and they didn't know it. So you just have to be super careful in this area. This
is the first I've heard about a deduction being denied. So does that mean when you file your tax return and you have this huge deduction against revenue to reduce income, they'll just turn around and say, nope, you still owe more taxes. They can just do that.
Well, as part of an audit, the IRS is going to want to look at it, and they may decide that it's not legitimate for one reason or another. Okay.
Wow.
I guess the thing is, what does a solar company, I mean, every landowner can do a conservation easement and probably get a deduction of some sort on that. And so I don't know. But I would just say that, that you got to be real careful in that area, in this area.
Okay. I'm going to bring up the 1040 just for any of us that don't actually look at the 1040. And in order for me to look at the 1040, I'm going to need my glasses. So when Michael was talking about deferring income, so from line 1A, all of this is showing to line 9, right? All your various kinds of income. One thing that I found pretty interesting is that dependent care benefits, are they considered taxable? Aren't they taxed when the person earns the money? And then if you have to pay for dependent care, and I guess I don't understand that line. What would be, you see that taxable dependent, you know what, never mind. That's taxable dependent care benefits, not payments, okay? So here, IRA distributions are included, pensions and annuities, if you have them, Social Security benefits, all of that comes down in line 9. This is your total income. And then you have adjustments to income from a schedule, and your line 11 is your adjusted gross income. And from that number, make sure I'm speaking correctly, Michael, we can put our deductions. So you can do the standard or itemized deduction.
Right.
And according to, what did you call it? That TCJA 2017, that act, they increased the standard deductions. Correct?
They do it every year. It's inflation.
They do it every year. But it was like a pretty big jump that year, right? In 2017.
But Julie, you're bringing up, what was your question again? I'm sorry.
In 2017, didn't they do a really big jump on standard deductions? Was that the year they did that?
Well, yes, the answer is yes. However, exemptions were no longer allowed as
Right.
as part of the tax return. And we used to get, we used to get exemptions for each dependent and all that. That all went away. Okay, but we still have the child tax credit and the credit for other dependents up under the dependent section here on the return. But go down to line 13. Let's talk about this. This is important.
Line 13.
Things that the IRS enacted was what's called the qualified business income deduction. And basically what that is it is up to 20% of your qualified business income can be exempt from tax as a result of this new deduction, which came about back in 2017. Now, what's important about the reason why this came about is because corporate income taxes went from being a 35% tax down to 21%. And there needed to be a way for the Schedule C taxpayer to have a tax rate that was substantially similar to a C corporation. So that's why this QBI, they call it qualified business income deduction, the QBID, that's why that came about. It is a way for self-employed folks to shelter additional income. And it can be up to 20% of your qualified business income or your taxable income. It's limited by your taxable income, by the way. So that's another way that you can save taxes.
So for your 1099, self-employed, things like
Right.
that.
1099 self-employed person, right?
Okay. One of the things, so for those of you that don't know, I invest in real estate, but I'm also a realtor. And quite a few realtors, well, they don't really keep their books in order. It's hard because you spend a lot of money to become a realtor. There's your, now I'm drawing a blank, but there's your fees, there's your advertising, there's all of your platform costs, like all of the things that you have, like zip forms to do your documents or DocuSign to get your signatures. All of those are paid by realtors to conduct their business, their broker fees, their MLS fees, their, say they subscribe to certain magazines or whatever to provide content or to help understand their training. There are a lot of fees that go into being and maintaining your realtor status. And then you make a huge commission. So it would be great if against that huge commission, you kept track of all of your expenses that it took to earn that commission. And so for anyone that thinks, oh my gosh, realtors make so much money, they take 3% or 6% or whatever. Well, they have to spend a lot of money to get those homes sold. And so you really need to get great at keeping your books up to date and current. Be very diligent with your record keeping. And if you do have to come behind and catch up, have a very systematic way of keeping track of those expenses. That's why I like credit cards, because you can always go back and look at that. One of the things that, so other—
By the way, Julie,
Mhm.
I just wanted to mention, you said credit cards. By the way, one way to accelerate expenses is to buy something on a credit card. And this way you don't have to pay the cash for it till next month. So you can buy things on credit and your credit card balance is sufficient to deduct that expense, FYI.
Well, let's just make a special note of that. Thank you, Michael. You can buy something on credit and then pay the cash for
It's
it.
an ordinary and necessary business expense. You can pay for it with a credit card and then pay your credit card down the road. And that you still get the deduction, the full deduction in the year of purchase.
I like that. And then where was I going with that? So there are a lot of expenses that realtors need to keep up. Is there someone else that'd like to share in their business what expenses they need to keep up with? Maybe they'd be applicable to all of us. Let's get some interaction, because look at this line right here. We've got standard deduction or itemized deductions from Schedule A. So you can do your standard deduction, keep it simple, or you can itemize, keep track of all of your expenses. One of the things I keep up with are my cell phone charges, my internet charges. I have a separate internet for my business. Those kinds of things, they add up.
By the way,
for my office. Yes.
the tax, the TCJA, also, by virtue of increasing the standard deduction, reduce the need for many taxpayers to have to itemize, because typically the standard deduction now is in excess of most folks' itemized deductions. So not only was the tax form done over, but it simplified the preparation of taxes and keeping up with your itemized deductions.
If your deductions are
itemized
deductions are lower. Yeah.
If your itemized deductions exceed your standard deduction, then obviously you'll want to itemize.
Then you want to itemize.
Yeah.
Okay.
Absolutely.
So what I would suggest is that as soon as possible, just take a look at this form. Has the 2023 1040 come out yet, or does that come out after the first of the year?
I don't know, let me take a look and see. I usually get that in November. I usually get all the new forms is when I get them.
So one of the things I will say, previous to starting my own business, I found taxes be like, oh my gosh, it's just something you got to do. It's not that important. You just got to do it. You can't change it. It's not that exciting. But now that I'm a business person, I'm excited. I love delving into the ways to properly mediate taxes. And I remember I went to a seminar, I think this was 2018, and they talked about two things, tax avoidance and asset protection, which we're not really going to talk about right now, but those were things that changed my mindset about being a business person. Once you start exercising good bookkeeping and document hygiene, you can take advantage of the strategies available for asset protection and for tax avoidance, tax mediation. Just, I don't know how to say, just, don't discount counting the beans in your business. That's what gives you some of the power to help mediate those expenses. So does anyone else have any questions that they'd like to ask? Because we're a little bit over time, but I don't want to miss out on anybody's opportunity to ask some questions.
I have a question.
Go for it.
Go ahead.
Okay, just a moment ago, you was talking about, how do you deduct your expenses as a realtor?
Mm-hmm.
And so my question to you is that, let's say, for instance, you're trying to transition, from W-2 to 1099 income to where you want to go to work for yourself. But in that transition, you're still making W-2. How can that benefit as far as write-off of your income from a W-2 standard, and also having something like home base, or you make enough to where you're getting 1099?
Right. Good question, by the way. Very good question. Yeah, there are a lot of folks that they've worked many years at a job. They get a W-2, and they decide they want to go out on their own. And I should mention that most people decide to go out on their own usually after they get they sever employment for whatever reason. A lot of people will go out on their own. A lot of people have a 401k that they built up over many years, and they use that to fund an entrepreneurial venture. So what happens is, that those first several years, you might not have a whole lot of income, but you've got a whole lot of expense. What can happen is some of those expenses can be used to offset W-2 income. You have to be careful. It's got to be, it's got to be reasonable. You have to have actually incurred those expenses. So I would say that it has to be looked at on a case-by-case basis. There are also arguments that can be made from reporting it on a Schedule C versus setting up a separate corporation or LLC. What happens is the IRS basically has a rule that says if you have not made income for 3 out of 5 years on a Schedule C, in other words, you've got losses, the IRS will say, hey, this is a hobby, and you can't deduct hobby losses. So that's something that has to be looked at and put in proper context that, hey, the accountant has to look at the situation and decide, what's the best way to handle this situation. So that's a perfect question to have with an accountant as far as tax planning for tax planning purposes.
I'd like to say that there are a number of people that have W-2 income and then want to become a part-time realtor to then transition maybe into full-time. And I didn't do that, but I know of someone, and let's see if what they did was correct. They had W-2 income, they had significant realtor income or revenue. They offset the realtor revenue against offset realtor expenses against the realtor revenue for that income. And then they took advantage, this was a couple of years ago, of that accelerated depreciation you could do on a car greater than 6,000 gross vehicular weight. And that took care of most of the rest of it.
Let me just say this too, Julie, and even if some businesses take 5 years before they become profitable, okay? And that means that you have to fund it, you have to loan money, you have to put your own money in the deal, and it just takes that long, okay? In some cases, these startup expenses, have to be deferred until a later, have to be deferred in terms of a deduction to a later date. But, that's a discussion where like, I might want to move a client away from, instead of reporting their LLC on Schedule C, I might want it to be, might want it to be an S corporation that they can then move those losses over to Schedule E and then utilize those losses against income. You have to look at it on a case-by-case basis, but there is a way to, properly, there are specific rules on how that has to be handled. And what I can say is this, is you want to avoid hobby losses on Schedule C. And if you're going to have a long startup period, there's probably some tax benefit that can be created from Schedule E. And that's just something that has to be looked at. And planned, I might add.
Planned.
Right.
So let's say, for example, you're starting a business where you have to put in considerable financial assets and you don't really anticipate making money until year 7. Let's say that's your plan. Your business plan has you in the black, making income, positive income in year 7. How does that get around the hobby rule? Because what you're doing is in capitalizing those startup expenses. How does that get around the hobby, I guess, disqualification if you're not going to make money in the 7 years?
Well, let me say this, assuming you have no W-2 income, you create and you have a Schedule C business and you have losses for, they're hobby losses, those will never be deductible. But if we get you over to Schedule E, and assume you have no W-2 income, well, you're going to end up having suspended losses that are going to have to be carried forward, and so that's, that is a problem. The situation is where you have W-2 income and you have business losses. That's where you have some wiggle room, okay, to offset some W-2 income and other ordinary income with business startup losses.
So you can offset ordinary income with business startup losses. Before we go, one thing I'd like for you to touch on real quick is the difference between long-term and short-term gains and what losses can be carried forward. Actually, I'm not sure how I want to phrase that question.
I think I know where you're going with it.
Yeah, I don't know how to phrase it, but well, yes, but
So
I
Julie,
might have to pose that question and
Yeah.
once I have it in my mind and then post it later, because I don't really have clear how I want to ask it, because it's nuanced.
right. So, let me say this, that you can only deduct losses to the extent of gains. Okay, and those unused losses carry forward indefinitely. Okay, but so that's capital losses in general. The difference between short-term and long-term capital losses are the holding period of the investment. Anything that's a year and a day is long-term. Anything less than that is short-term. Short-term is taxed at ordinary income tax rates. Long-term is taxed at favorable rates. And in some cases, depending upon your adjusted gross income, those capital gains can be taxed at 0%. So it just depends on, let me find the 2023 brackets on that. 2023 cap gain brackets. Okay, hang on just a sec. Okay. So let's just talk about single. If you're a single taxpayer and you have income up to taxable income up to $41,675. This is 2022, by the way. Let's talk about 2023 because that's where we're at right now. You're single, you can have taxable income up to $44,625, and you won't pay any capital gains taxes on that on any capital gains. If you're married, file jointly, you can have taxable income up to $89,250. And then within certain ranges, there's either a 15% rate, or for large income or high income taxpayers, there's a 20% rate. Again,
So Michael, would that mean that, let's say I have anticipated capital gains and I know that next year I'm only going to make 20,000 of ordinary income, so I can choose to take advantage of massive capital gains in the year that I make less than 44,625 as a single?
well, your taxable income, it's going to be taxable income after capital gains. Okay, so if you've got a large amount of capital gains, it's going to put you over this. It's going to put you over the 44,625 bracket.
Oh, so the 44,000 something includes your capital gains.
It's really for it's really for lower income folks get to benefit from that. It's really for the smaller folks that have capital gains.
I was going to think, okay, so all I got to do is get my income low and then take large capital gains. 50%
range kicks in from 44,625 to 492,300. So most folks are going to fall in the 15% rate. Yeah. Some folks will be over 492,300, and that'll put them in the 20% bracket.
You want to make some money in between that gap, so you feel like you're doing something instead of the government taking all the money.
Right. I mean, some people say, okay, they'll come to you and they'll say, okay, look, I can sell $100,000 of stock, but I don't want to pay taxes on that. What do I do? And I'm like, well, sell 20 of it now, and keep you below 44,000. And there are people that have less than 44,000 of income, but they might work for a company that puts 5,000 a year in a retirement account. And so, but if they do it in a retirement account, capital gains are not going to get taxed at all as part of an IRA. Okay, but you do have some people that get, let's say, like a stock. They might have an employee stock option plan, so the employee gets stock, and it's not a lot, but you know but it might have accumulated to 100,000 of stock, and they don't want to pay tax on it. Well, just sell 20,000, and you still come in under the 44,000 taxable income bracket, and that's really, you know, that's it's really to help the smaller guy, smaller person, smaller guys and gals, that 0% rate. Hopefully,
Okay.
most of us make over, you know, $44,000. So
I have another
anyway,
question for you. Okay, in order to get established, you had mentioned earlier about the importance of keeping good books. And just like in order for a house to stand, you have to have a well foundation before building on it. Well, it's the same thing with your finances and tracking your finances and keeping up with your, the information to bring into, like, say, for instance, I'm bringing my taxes to you. In order for you to do me some justice, I have to have at least good books for you to determine what strategies we're going to take in order for me to at least not pay in so many taxes or use tax advantages that's advantageous to me. So what are some good ideas as far as bookkeeping or tracking my own books, starting from, home? You ain't got good books at home, you're not gonna have good books in your business.
right. Let me say this. There are products out there. QuickBooks has a product for your phone, and you can just enter every time you have a business transaction. You can enter it into QuickBooks on your phone, and boom, you're keeping up with your books. Some folks are able to get by on keeping a checkbook, and that's it. But you can't be proactive if you probably can't be very proactive if you're not staying up with your books in general. And then you have to be reactive, and usually reactive after the fact, I can't help you as much as I could on a proactive basis. Yeah.
Okay.
I'd like to just say, before I started my business, I used Quicken. Well, at first I used spreadsheets, and then I went to Quicken. And at that time, I don't know if it is now, it was pretty inexpensive. And you can connect your bank accounts and your credit card accounts, and you just make sure you spend something trackable. And then you every once in a while go and you can categorize your different types of expenses. So back then I was like, are they groceries? Are they toward home improvement? If you're a homeowner, keep track of the expenses you put toward your home. Let's see, car expenses, savings account. It enabled me to both make budgets and track expenses. And then when I moved over to trying to use QuickBooks, well, first of all, that's a completely different animal. They both have quick in it. But that's pretty severe. So I don't think unless your business is huge enough where those kinds of things make sense, that can't be easily deducted from like a spreadsheet, keeping track of how much you spend on gas, how much whatever, then I would say QuickBooks or spreadsheet would work, as long as you're diligent about it and have the records to back it up. The QuickBooks for me came into like real play when I wanted to do tax mediation, really strong tax avoidance strategies, as well as when I was in the middle of a lawsuit and I had to prove losses that I had sustained. And so I needed to be a little more careful with my accounting.
I'd like to add something on that, Julie. Here's the thing is, the larger you get, the more complicated it becomes. You've got to have internal controls over your financials. And I'll give a very simple example. In January 1 of 2023, you paid an invoice, okay? In October of 2023, the vendor calls you up and says, hey, I never got payment on this invoice, you know? You go ahead and you pay it because you forgot perhaps that you paid it. Just think if you had 1,000 transactions a month that you had to keep up with. So you got to have the internal controls that, you know, that will prevent you from making mistakes, that will catch you making mistakes. And that's the benefit of automation in accounting automation. And so, but for, you know, for someone like yourself that may be just, you know, starting up, you can just keep up with your stuff. You can take pictures of a receipt. QuickBooks even posts that receipt to an expense automatically. And all this stuff can be done very quickly, just a few seconds. And you're keeping up with your books. And from that, you can generate a profit and loss, generate a balance sheet, you know, all that stuff. So it's hard to have a good excuse why you aren't staying up with your books, given today's accounting automation, is what I want to say there. You know,
It is easier to keep up than it is to catch up.
right?
But you're speaking to the proverbial catch-up queen here. So, you know, I can't say I'm always awesome on it, but I do, you know, put in the work to catch up. And it is a good, how did you call it? Internal control to your business. So don't think of it as an obligation to save you money on your taxes. Look at it as a strategic tool for your business.
Right. Absolutely. And, you
Maybe
know,
that helps with the
all of us
motivation.
in business, we start out with one customer and it just slowly grows and grows and grows. And that's how small businesses become medium businesses, become large businesses. So anyway.
We are running a little bit over. Thank you so much, Michael, for staying extra and for your insights.
My pleasure.
I had at one point, Shamir, if you don't mind, if you have access to it real quick, just copy and paste Michael's information, or at least his website in the chat so anyone can get to it, and we'll also post it. Also, I realized that for some reason this did not post on Facebook, so we'll post the YouTube video on Facebook. And if you get a chance, go over to my YouTube channel and subscribe and like and comment. I'd really appreciate it. And I hope everyone has a wonderful evening. Thank you so much. And I will see you all next week. Mwah.
Thanks, Michael.
See you all soon. Bye-bye. See you all soon. Bye-bye.
Appreciate it.
Beautiful.
Okay. All right.
Bye.
Bye-bye.
Awesome.